Why is it so critical? Well, cash is highly negotiable. People can steal cash very easily, and that means that it's even more important that we protect it more heavily. Question 15. It's asking us for the reason why we should bank our takings daily. Well, what's the point of building up a war chest of money, just inviting someone to come and steal it, all right? So we should, as we get our money, we should bank it, and the safest place for it is in the bank, not under the bed, all right? So it's important that we don't keep much cash on hand because it invites people to come and steal it. And in fact, that's why most businesses now do their banking online. They don't have much money on hand in the companies themselves. Part B, the bank reconciliation statement is about reconciling our records with the banks to making sure that they are both in agreement, and if they're not, we have to find out why. What is the reason why they are different? And part C, why do we have to segregate duties? Well, segregation of duties is important because if you have one person doing things that are in conflict with one another, in other words, they're incompatible, it gives them the opportunity of misappropriating money from the organisation and then being able to cover it up by, changing the books to make it look like nothing's happened. All right, question 16. It's talking about explain why we need controls in mail opening. Right? Well, if there's any money being received in the mail, it's very easy for someone who's opening the mail, if they're on their own, they can put it in their pocket, all right, and just say the cheque didn't get received. So that's why it's recommended that there are always two people doing it, one watching and the other one doing. Part B. We have to also record everything that we receive in the mail, all right? That's a good practice to record any monies that have been received into a book or a register, and that then can be reconciled with our records later on. Part C. This one is asking for the cashier to receive the bank validated deposit slips. Well, again, that's going to be a conflict of duties if you have the cashier doing that particular role. So it's better that, even though the cashier might have some spare time, it's better if those duties are separated. And then point D. With small expenses, it's probably best if they're put through an impress system of the petty cash, because instead of having to draw a cheque for $5 or $10 for milk and sugar and things like that, it's better if we have just a small float to pay those things out of pocket expenses. And part E, well, that's a bit of a silly one, saying that the cashier takes flexi time on Wednesday and likes to attend a local race meeting, and he asks management about not banking on a Wednesday, right, and keeping them in the safe. Well, I think that's, again, as we said earlier, it's not a good idea. The banking should be done daily, and if he's got a Wednesday off, well then someone else should do it. Okay, let's move on to problem 711. Problem 711 is asking us to prepare journal entries for the petty cash. So you can see here we've got a whole lot of miscellaneous petty cash items for the month of August. And collectively they don't add up to very much. The float is for $250. So with a petty cash float, what we normally do is we start with a fixed amount, say 200, 250 or whatever it might be. And then as we incur expenses, we progressively pay out of that float. So the float gets reduced until it gets close to nil. And then we reimburse it with the total of the expenses that have been incurred, bringing the float back to its original level. That's the whole theory behind the impress system. So they're asking us to do the journal entries for the float. So all we need to do is to identify each one by item and then record them in the journal with the petty cash as the other side of the equation. So you can see here we have our initiation of the petty cash fund being established, and then we have the payments for various items, and as you can see the fund is reimbursed back to its original level of $250. Right, number 13 asks us, why is a bank reconciliation prepared? Well, we did answer that before, so I won't go over that again. But the second part is asking us, under what circumstances would it be unnecessary to prepare a bank reconciliation statement? Well, probably the only circumstance I can think of is if the balances are the same, all right? If the balance per the bank and your records are identical, then you don't really need to do anything. But in all other cases, it's a good idea to find out what the difference is. You know, it might be an error on your behalf, or it might be an error on the bank's behalf, and you do really need to fix that as quick as possible. I was working at a client's once up in Sydney, and a surprise to me, that client hadn't reconciled their bank statement for 3 years. Can you believe that? 3 years. I find that staggering. 3 years, they didn't bother to reconcile their bank statement. And I said to them, well, I'm not going to do it. I was the auditor, and I said, it's not my job to do it. I'm here to check it, and I'm just going to report the fact that you haven't done it for 3 years, which is, you know, something that the board is going to be pretty angry about. And then they said, well, don't tell the board, all right? What say if we pay you extra money to do it? I said, well, that would be a conflict of my duties, because I can't be the accountant and the auditor, all right? I've got to wear one hat or the other. And then they said, well, what about you get another employee to come and do it for us, or get someone else to do the audit and you do the... So anyway, we got someone to do it for them, and it all turned out okay, but it did take quite a long time. I think it took them about 3 weeks to do it, because the longer you leave it, the more difficult it is to try and track down records. So that's why it's best if it's done regularly, preferably monthly, although some big banks, for example, they do it daily. They do their bank reconciliations daily. As you can imagine, they've got millions of dollars being turned over every day, so they have to do it daily. All right, so what we're doing in number 2 is doing an actual bank reconciliation, starting with the bank statement, balance, Okay, so our bank statement balance is 16,860, and then we have to add back the outstanding deposits that haven't yet reached the bank. So they have to be added to that. And there was also an adjustment to one of the company's cheques. And then we have to subtract the cheques that we have drawn through our cash books but haven't yet reached the bank. So when they do, they will need to come out of the balance. So after adjusting for those things, it comes up to just a tick under 13,000. And then we have the reconciliation of our cash books. So we have the cash book balance, and we have the adjustment for a cheque that was incorrectly recorded, and some bank charges, and when we adjust for those two items, it comes up with the balance as per the bank account. So that's our reconciliation. The adjustments that we need to do are the ones that are going to reflect in our books, or haven't been reflected in our books. And that's obviously the bank charges and the adjustment to this cheque here, which the difference is $360. Okay, so they were the only questions that you had down for discussion this week. Has anyone got any questions arising out of those exercises? No? Okay, all right, that's good. I'll hand around the attendance register. While I'm doing that, I'll get the lecture slides up for today. Okay, we're all set to go. So today's topic is on accounting for receivables or debtors. And some of the things that we'll be visiting today will be the use of control accounts and contra accounts, looking at how we determine an allowance for bad and doubtful debts, writing off bad debts, reinstating bad debts that have once been written off and now need to be added back again, and finally accounting for GST. So they're the things that we'll be covering. That's the things that you need to understand, or you will understand by the end of today's class. All right, now one of the things that Igor gave you last week was this revision question, all right? And we were going to, well, we will discuss it now, which is the first thing we'll do in today's class. So let's have a read of it. The Royal Australian Mint misplaced more than $1 million last year due to unauthorised payments that were made from its bank accounts by a former employee. Suggests several internal control mechanisms that the Royal Australian Mint could have adopted to prevent the fraudulent cash transfer. Okay, now before we answer this particular question, as you can imagine, the Australian Mint has money everywhere. all right? Money everywhere. And all of the employees that work there come under a lot of scrutiny. Before you work there, you can't work there if you've got a criminal record or you've got, you know, any skeletons in the closet at all. But that doesn't mean to say that the people who are working there are honest. It just means they haven't been caught, all right? And in fact, over the years, there's been a lot of cases to do with the mint, right, where people have misappropriated money, right? This is just one example. I've got a friend that works there and he tells me a lot of stories, right? A lot of stories. I'll just share one with you, which you'll find quite amusing. Before this happened, a few years prior, they had a system of destroying old currency, right? So when a note gets torn or damaged in any way, the bank will take it back and send it back to the mint, all right, for destroying. And they collect them all, and then at the end of the week or end of the month, they incinerate them. But before they do that, they obviously record all the serial numbers and the denominations and everything. And there's two people that are in charge of doing that, right, destroying these notes periodically. Anyway, on this particular day when they were due to do it, one of those gentlemen had a sickie, right? He didn't turn up for work. And so the other guy thought, well, he's not here, I'll just do it on my own, all right? And there's obviously a reason why it should be done in pairs, because we don't want people pilfering the money. But anyway, when one guy did it, of course, that's what happened, right? He took the box of the currency to be destroyed, went into the room where it's supposed to be incinerated. Unfortunately, they didn't have a camera in there. They had a camera going in and a camera going out. And anyway, he managed to stuff it in his clothes and or as much of it as he could everywhere, so he couldn't be detected. Pretended that he'd incinerated it, and walked out. Right? And a few months later, these notes that were supposed to have been incinerated started popping up at banks all over the country. Right? And then they thought, well, hey, you know, because the banks have a record of notes that have been destroyed or supposedly destroyed. And they said, hey, what's going on here? And then they said, well, these were supposed to be destroyed on this particular day. Let's see who did it. And this guy's name came up. And so then they gave him a please explain. And of course, he owned up to the fact that he didn't destroy them at all. He just kept them and thought he might use them. And it was, you know, around $1 million as well. So, so there you go. People are not all that honest when it comes to money, especially big money. All right, they tend to use the opportunity to take advantage. All right, so let's have a look at this situation. How can we put in place some controls to stop money being fraudulently transferred out of the bank? Right? What would be some of the things that we could do? Did anyone have a think about it? Sorry, say it louder. Yeah. Well, that's one important thing. We make sure that nobody does the same thing for too long. And if we regularly rotate the duties, that's certainly going to minimise the risk. Right, what else? Pardon? Internal auditing, okay, yeah, we could have some, in fact they do have internal auditors, but obviously they didn't work on this occasion, but yes, if they were more diligent and perhaps they were given more specific guidance as to what to look for, that could be another internal control mechanism that we could use. What about the fact that the payments are unauthorised? All right. Sorry, how how could he get away with payments that weren't authorised? Right? That's what amazes me. All right? I would have thought all the payments should have been authorised. Right? Any payment. You wouldn't expect that any payment would be made from the bank account without authorisation. It seems staggering that they would have allowed such a thing to happen. So perhaps they need to have more oversight and more monitoring of the payments and reconciling them so that these things don't occur. We could also make sure that the amounts are not too large, right? That's going to minimise the possibility of, large amounts. It's not going to stop small amounts, but if it's a small amount, people are not likely to want to do it. And as we said, having someone else to authorise large transfers, limiting access to internal staff, regular audits, we mentioned that one, and regular reconciliations, I mentioned that as well. All right, let's get started on today's topic now, which is accounts receivable. So accounts receivable is usually one of the largest items in a balance sheet, apart from inventory. Inventory and accounts receivable, particularly if you're selling things on credit, it's going to be a fairly sizable amount. And as a result of that, we need to make sure that it's accounted for properly. So the accounts receivable is the money that we have not yet received from our customers. Why do we have credit sales? Well, not everybody wants to pay cash, and in order to encourage people that don't have money at the moment or don't have access to it, we can still make our sales, and or we can still give them a sale, but we just make it by credit rather than by cash. And it also allows us to compete against other companies in the industry. It's also part of our operating cycle. So the operating cycle, if you're not sure what it is, it's the cycle of money that goes around. So we start off with our pool of funds, and we use that to buy some goods and supplies and to manufacture goods if we're manufacturing them. And then we sell them, we start to get some money in, and then when we get some money in, we use that to buy more materials, and so it goes around. So that's what we refer to as the operating cycle. So cash, inventory and receivables are all part of the operating cycle. So our journal entry that we need to process for credit sales is to debit the account receivable, because that is an asset, and we credit our revenue. When the money is ultimately received, we then debit the cash and credit the account receivable. And obviously it's in an entity's interest to make sure that they manage their accounts receivable well by encouraging businesses to pay promptly, so they might offer them discounts, and they may also provide them with disincentives for paying late, such as giving them penalties or charging them interest if they're too tardy in paying their amounts that they should. So it also helps our cash flow, which is very important for business. And we often have what we refer to as contra accounts. Now, a contra account is an offsetting account or a negative account that is taken off the original account. So in the case of debtors or accounts receivable, the contra account is the allowance or the provision, and that is taken off the accounts receivable balance because these relate to items that are not likely to be received. That's why we've created an allowance for them. We have created an allowance for these items which we've estimated, and we're going to go through how we do that a little bit later. But that will give us insight into the net amount that we expect to receive from our debtors. Because when we're preparing our financial statements, it's all based on prudence or conservatism. And it's important that we don't overstate the balances in the financial statements. So that's why we have to make sure there's an adequate amount of an allowance taken up. The same with property, plant and equipment. Right, we haven't talked about that yet, but we will in future weeks. The offsetting account there is the accumulated depreciation. Some of you have done accounting before and you'll appreciate that that comes off the PPE. Or intangibles. Again, we'll be talking about them at a later time as well. And with those, it's usually the accumulated amortisation that gets deducted. Or with inventory, it's provision for obsolescence. Or with investments, it's provision for diminution in value. So there's many different accounts that we have in accounting that have contra accounts or offsetting accounts, negative accounts. Right, the next question is asking us, what are bad debts? Well, a bad debt is, as the name implies, a debt that has gone bad, and it means that we're not likely to get it. The customer has, for a whole range of reasons, it might be that they don't want to pay us. Maybe they just want to keep their money, all right? Or it might be that they disagree with the amount. Or it might be that they don't have the ability to pay us because they just don't have enough cash flow. But whatever the reason, there's always going to be a certain percentage of our customers that won't pay. And we have to acknowledge that and just make a provision for it. Now, it's too hard to chase them all through the courts. The courts are, chock-a-block at the moment with many cases, and unless it's an extra large amount, you're probably just going to write it off instead of wasting your time and legal fees in trying to get these guys. And most of the time, they don't have any money anyway, or they've shot through and can't be traced. So that's why we just write them off. And these are some of the reasons. Bankruptcy, can't be traced, they might die. I didn't mention that one. It's not worth the action of courts. Yep, that's right. Or there's a disagreement, which I also mentioned. So how do we account for the bad debt? Well, there's two ways in which we can do it. The first one is the direct write-off method, where we write off the amount of the bad debt, and the second one is to create an allowance, where we put it through an allowance and the allowance comes off the gross receivable. So we're going to have a look at both methods just so that you know how they both are treated. So with the direct write-off method, when we identify a debtor or part of a debtor that's not going to be paid or unlikely to pay, we debit an account called bad debts and credit the account called accounts receivable. So it's not an adjusting entry, it's an entry that we often do at year end, and the reason why we do it at year end is because when we're preparing our financial statements at the end of the financial year, we want to make sure that our debtors are not overstated. So we do an appraisal of all the debtors and see which ones need to be written off and which ones don't. So at that point, obviously we do a scrutiny. If it comes to our attention either through a solicitor or a liquidator that one of our clients has gone bust, well then we can write it off straight away. But often is the case, we do it at year end. One of the problems with doing the bad debts this way though, is that it doesn't follow the matching principle. Because with the matching principle, we try and match revenue with expenses. And if we wait until the debt is really bad and not likely to pay, we might be waiting 2 or 3 years, all right? The guy mightn't pay us for 2 years and he might keep promising and promising and just stringing us on. And then eventually we find out he's in liquidation and we're not going to get anything. So then we write it off. But what's happened is that we've recorded the sale 2 or 3 years earlier and we've recorded the expense in the next accounting period or the one after. So it's not matching. That's what the point is there. It's not matching. It's much better to try and match them in the same accounting period if we can. So at the end of the period, that's why we do an appraisal. So that we can make sure that things are occurring in the same period, if possible, all right? So if we've recorded the sale, then we can also record the bad debt if there is going to be one. And that way, it's going to be better matching the accounting periods. All right, let's have a look at an example to illustrate this. So on the 1st of June, we make a credit sale of $1,000 to Larry Tan, net payment in 60 days. At the end of June, we send him a statement, all well and good. 30th of June is the end of our accounting period as well, so we record it as an account receivable. All right, by the 1st of August, 60 days expire and he should have settled his account, but he hasn't. Okay, so we're still waiting for him to do that. Another month later, we send him a reminder letter and ask him for payment. None forthcoming. We send him a threatening legal letter. Still nothing happens, and we find out 3 weeks later that he's gone bust. So the account gets declared as bad. So at the 30th of June, we have an account receivable of $1,000. And if we haven't finalised our accounts by the 20th of October, we can go back and offset that amount with a write-off adjustment at the 30th of June through an allowance. However, if we've already finished our accounts, and we might have by that date, we can't do anything. So it gets recorded in the next accounting period. So you can see the dilemma that we're talking about. This is the end of the financial year, this is when the original sale occurred, and this is when it went bad. So the profit gets distorted in each of the accounting periods. Here it gets overstated and here it gets understated. So it's best if we can have an eye to the future at year end and try and foresee any potential bad debts. Doesn't matter if they don't eventually become a bad debt, because the whole purpose of this is to be conservative and make sure that we don't overstate things rather than understate them. Right, the second method that we're going to talk about is the allowance method, and this method does take the matching principle into consideration. So let's see how this pans out. What we do at the end of the accounting period is we estimate the amount of our uncollectibles, and we then do an adjusting entry for that. And the adjusting entry is to debit our expense for bad and doubtful debts, credit the allowance, and the reason behind that is because we're not sure whether it's going to be paid or not, but to be on the safe side, we're going to create a provision for it anyway, because we're probably more likely rather than less likely that it won't happen. It also allows us to look at the collection policies that the company may have and see whether that's had any impact on the amount of bad debts. If they're good at collecting, or they've got a good credit manager that follows things up promptly, then it's more likely that the bad and doubtful debts will reduce. But we have to also remember that these are only estimates, right? Often these amounts are estimates based on historical data, or they might be based on looking at specific accounts and making an assessment or a judgment call as to whether or not they're going to be collected, or whether part of them is going to be collected. So we'll do that discussion a little bit later, but some of the methods that we'll talk about are the percentage of sales method and the ageing of outstanding debts method, which are often referred to as the income and the balance sheet approach. And then later on, if we do have the bad debt that finally gets written off, then we do that against the allowance, not the account receivable, by debiting the allowance and crediting the account receivable. Now, one of the things that we do this for is to make sure that our accounts receivables are recorded at their net realisable value, the figure that we're likely to get or we're likely to collect. And that's what the accounting standards tell us. So let's have a look at an example here. If we have an accounts receivable balance of 85,000, and we know that one customer of 1,500 has gone bankrupt, and in addition to that, we, based on past records, show that 5% of the other customers are unlikely to pay, so we can then reduce our accounts receivable balance down to 79,325. So how do we get that figure? Well, this is how we do it. We take the 1,500 off straight away. which gives us 83,500, and then we take 5% of that, right? 5% of that figure, which gives us 4,175. We take that away from that, and that gives us the 79,325, which is shown as our net receivable. So the 1,500 customer has been written off as bad, and then the other 5%, or 4,175, are actually doubtful, right? There's a potential that they may not pay. Now that is only an estimate. It might be over, it might be under, but we try to be conservative. If we're going to err, we err on the side of caution. And this is the preferred method that we use in Australia. And the main reasons is that it fulfills the matching principle, it's faithfully represented, and it's more relevant. And that's why. All right, it's your turn to now do a little bit of work. So I want you to do some journals for these items. The first one is to record credit sales. And the next one is to record the collections. And then we'll go to the receipts and the amounts that are uncollectible. Okay, so I'll give you about 5 minutes to do that, and then we'll have a chat about it. Who has the attendance record? Where is that? Over there. Who's ticked their name off? No one. Right. So it seems to have stagnated over there. Can you please circulate it, please, so everyone gets an opportunity to tick their name off? Thank you. How are we going? Are we nearly finished? Nearly finished, folks? You done? No? All right, I'll give you another minute then. All right, I think you've had long enough. So let's look at the first one. What's the journal entry for the credit sales? Can someone tell me? Pardon? Correct. All right, so we debit the account receivable and credit the sales revenue. What about when we receive the 365,000? What's that entry? Yep. Yep, that's correct. Cash and accounts receivable. So that means, how much have we got left in our account receivable now? 135, right? And we're told that we're only going to get 100,000 of it because the 35,000 is expected to be uncollectible. So what do we do with that? Yeah, that's right. We create an allowance by debiting bad and doubtful debts and crediting the allowance. All right, let's move on to the next few. All right, number 3. Customer hard to find owes 23,000 and he skipped the country and the amount needs to be written off. Okay, so do that. And then 4 and 5. Finished? All right, everyone else finished or not? You done, you girls? All right, okay, let's go through it. All right, so here we have a customer that has skipped the country, so obviously this one is a bad debt. So what we're going to do is we're going to write it off against the accounts receivable, and we do that by debiting the allowance and crediting the accounts receivable with the 23. Question 4, what is the impact on the income statement for the year? Okay, so we can see that the sales revenue has increased. If we go back to the previous page. Let's do that. Yeah. All right, we can see that our sales revenue here has increased by 50,000. We can also see the impact on our accounts receivable. All right, we're looking at the net effect. All right. The bad and doubtful debts increased by 35,000. Our cash by 365,000. And our allowance for doubtful debts by 12,000. And our accounts receivable works out to be 112,000. All right, so let's have a look at the two methods that we talked about before. There are two methods that we can use to do our estimations. The first one is called the income statement approach. And the way in which we do this one is that we calculate it based on a percentage of net sales. So net sales are our gross sales minus any sales returns. And the percentage that we use is based on trading history. So we see what the percentage was over a number of years, and then we might take an average or adjust it according to the economic situation. So that's the income statement approach, and let's look at an example of how it is panned out. Right, let's look at the example here. Past experience tells us that 1% of net credit sales will become uncollectible. So let's assume that our net credit sales were 640,000. Therefore, our entry that we're going to do for the adjustment for bad debts will be 1% of that, which is 6,400. So we debit the bad debt and credit the allowance. Right, so it seems fairly straightforward, but it does have its limitations. So what are the problems with this method? Well, it doesn't take into consideration the present balance, right, that we might have in our allowance. We don't know whether that's sufficient or not. It ignores things like the customer base. They might be different from one year to the next. It ignores things like credit ratings and risks. And it ignores any outstanding debtor balances, which also might be important in taking into consideration. Okay, so let's have a look at another example, and this time you're going to do the calculations. So past experience has shown that bad debts over recent years average 2.5%. Credit sales for the current year were 468,000. Let's do the adjusting entry. All right, so I'll give you a couple of minutes to work that one out. let's have a look at the answer for this one. So we're going to take 2.5% of our 468,000, and that works out to be 11,700. So we debit the bad and doubtful debts expense and credit our allowance with 11,700. All right, the other approach that we can use is called the balance sheet approach. Why do we call it the balance sheet approach? Because we look at the balances of the debtors. And if you look at all the weaknesses of the previous method, the income approach, well, these become some of the strengths of this approach. But then again, this approach also has its limitations. So neither approach is considered to be infallible, but this one is generally considered to be a little bit more accurate. So what we do is we take into consideration the ageing of the debtors. And by doing that, we recognise that debtors that are older are less likely to pay. And that makes sense, because the longer that a debt has been on the books, the chances of you getting paid are decreasing every month. And so we recognise that and take that into consideration. And we calculate probabilities of each one being uncollectible. And then we add them all up, and that's the amount of our allowance. And we also look at our opening balance, and we do an adjusting entry to make sure that the closing balance is the amount that we are looking for. So let's have a look at an example. So this is what our past experience tells us. If the amounts haven't yet come due, well, 1% of those we might not never get. Those under 30 days, it blows out to 3%. 30 to 60 days, it's up to 9%. 60 to 90 days, it's 16%. And then over 90 days, it's 25% or a quarter of them. So that's what past experience tells us with this business. At the 30th of June, this particular business had the following balances in their aged accounts receivable. Right, all those different amounts. So what we need to do is we need to multiply these percentages by these amounts here. And we're also told that the present balance in our accounts for doubtful debts is 1,200. So that's our starting point, and when we do our adjustment, we have to take that into consideration in reaching our final balance. So here's our calculation. We've put it into a bit of a table to make it easier to understand. So we've multiplied them all across and then added them down, and it appears that we need an allowance of 2,345. But we also had 1,200 in the account already. So when we do our adjustment, we only need to adjust for 1,145 to give us our closing balance of 2,345. So therefore, our journal entry in this case is going to be debit the bad debts expense and credit the allowance with 1145. All right, I'll give you an opportunity to do one yourselves now. So what you need to do is to just do it very similar to the example that we just looked at. You have an opening balance in your bad and doubtful debts. You also have an opening balance of our accounts receivable. You have to write off a bad debt, and you also have to make a provision based on the percentages here. Do the aged analysis and do the record of journals for me. Okay, so I'll give you about 10 minutes and we'll see how we go with that one. And if you've got any issues or questions, just stick up your hand and I'll come round and see how you're going. Yes. Why? Because that's what we were given in the question. That's yes, that's information from the question, not something we calculate. All right, I think most people are almost there that are going to be there. Some of you may not be quite there, but let's go through it and then we'll have a break, okay? So we'll have a break just after 6:30. All right, so looking at the facts, right, we have to obviously, a few people asked me as I went around, when you work out the amount of the provision, why do we take into consideration the opening balance? Well, the reason is that the opening balance is a carryover from the previous period when we did our calculation and we found that it was either too conservative or too optimistic and there was a bit of a balance left over. So obviously we have to take that into consideration with this method, not with the income statement method, but with this one. So consequently, that's why there's an adjustment, either adding or subtracting the balance depending on whether it's debit or credit. So what we need to do is to do our age analysis in accordance with this formula, and secondly, do our journals. All right, so let's look at the age analysis here. So we've got our amounts and the multiplying them out. Obviously it comes to 7,800. So I hope you all got that part. That's pretty straightforward. Yep, good. You're all nodding your heads. So I hope you're not doing it because you're falling asleep. No. All right, now we do the journal entries and we have to write off the bad debt that went bankrupt. So we do that by creating a deduction from our accounts receivable by crediting it and debiting the allowance for doubtful debts. Then after having done that, we then do our adjustment for the allowance for bad and doubtful debts. Now it comes to 10,800. Did anyone get that figure? Some people did, not everyone by the looks of it. So let's see how that figure worked out. Remember, we had 12,000 as our beginning balance, all right? Then we had to write off 15. So then we became 3,000 negative, right? 3,000 in debit, okay? And we need to do an adjustment for 7,800, right? That's what we want our closing balance to be. So therefore we have to add the 3,000 to that to give us an adjustment of 10,800. Does everyone follow that now? Anyone that doesn't, put up your hand, because I don't want you to be not understanding it. Yeah, makes sense? Yeah. As I said, sometimes the adjustment might be a debit and sometimes it might be a credit. Don't just expect it's always going to be a credit. Okay, well, if you don't have any questions, we'll have our break now. And as I said, it's just gone 6:30, so let's resume in about 10 or 15 minutes' time, so you can have a well-earned rest and some liquid refreshment, and we will resume shortly.
都是粤语，下周贴过来的全都。Finance，我也有那个 BPM，我就选3个，我选4个，然后刮了一下，我们刮了就。大家改过啦，结果。
Okay, are we all right to go? Okay, let's continue where we left off. So we just finished doing this exercise. Let's now have a look at another one. All right, this one is Luxter, or Luxter, and he gives us the following details. Opening balance, 2. Closing balance, 3. Credit sales, 8. Bad debts written off, 1. How much is the cash received? Now, what you need to do here is obviously do a reconstruction of the accounts receivable ledger. And one of the reasons why we do this is to make sure that you put things on the right side, right? To put the debits on the debit side and the credits on the credit side and work out the correct amount, because you'd be surprised how many people get into the next accounting unit, which some of you will do, and they still can't do T accounts, right? So that's why we emphasise it and make sure that you guys are prepared for the next step if you choose to do that. Right, I'll give you a few minutes to sort that out and then we'll go through it.